Good afternoon, everyone. My name is Alex Sunners. I'm joined by my colleague here, Roger Bear. And today we're talking about investing for a worry-free retirement.
And who wouldn't want a worry-free retirement? I mean, it's kind of the opposite of what we worry about. Investing can be an area where our clients, where the public gets very concerned about what's going on. So I think this is a great topic, Alex.
Yeah, and I think a big thing is when people shift into retirement, it's this big mindset shift of you're saving all your life, you're investing, and then you make that shift into, okay, now what? Now we are drawing upon those funds, and maybe investments have to change a little bit now that we're in retirement. So we're going to talk about all that today. So
In
first, we just have to start off with what is retirement planning? I think everyone has a different vision for what planning for retirement involves. People say, okay, yep, I'm younger now and I want to retire in the future. The steps to get there is not just straightforward. There are a lot of different things we have to think about. And the first thing I would think about is you have to set goals for what do you want to spend in retirement? Is it more, less, or the same as when you're working? Do you want to travel? A lot of people have big travel goals when they retire. They want to go see the world. Well, that's something you have to think about before retiring, making sure you have those funds available for that. Do you want to buy cars? Do you want to do celebrations? All of these things that you have to set these goals for in retirement. Some goals that you might not think about that you just assume are going to happen are things like healthcare or things like moving to a different state. These are things you have to start thinking about early on so that when they are happening, you're not surprised by them.
Yeah, now, Alec, one thing I would add is what's retirement planning? It's having a plan. You definitely need to have a plan. Plans don't necessarily need to be perfect, and we know they're going to be monitored as time goes on, but you really should sit down exactly as you began by deciding, okay, I'm going to have a plan and I'm going to begin by setting goals. And then the next leg of the plan, as you can see on the screen, is saving, making contributions to your retirement accounts. It's also, I think, a lifestyle choice. We got to realize at all points in your life, you need to be saving for tomorrow. And that's a habit that you've got to take on early in your life and continue into retirement.
Yeah, and you have to have a plan for that saving. And we're going to go into later in this webinar just how different plans can come to fruition as you retire. But the other thing with saving and investing is you have to assess other income you're getting in retirement that can supplement those investments. So, what is your Social Security benefit? Are you getting any pensions? What other investments do you have outside of retirement accounts? These are things that you can draw upon in retirement that help give you that cushion on top of 401ks and IRAs that you can draw upon before having to draw out of your retirement accounts.
Indeed. And the one characteristic of retirement income is you probably have several sources of income, as you've identified here. Whereas during your working life, you probably just have earned income from employment. Well, in retirement, you at least will have Social Security and income from investments, and you may additionally have pension income. So those are additional considerations. As you said, you've got to assess where will my income be coming from when I am retired.
Yeah, and that last step for planning for retirement is you have to manage the risk of retirement. It's a big shift. You go from working all your life, getting a steady paycheck, and then all of a sudden, now you're dependent on all of the savings you've done throughout your life to live upon. So you have to think about things like the market fluctuations, unexpected expenses that pop up, inflation. These are all things that you have to keep in mind while you're creating this plan.
Well, and indeed, the thing about risk is there are many unknowns. We do not know when or how much the market will fluctuate. Clearly, unexpected expenses come up and they can arise at any time, and therefore you need additional savings. You need a reserve or an emergency fund. And the path of inflation. We've just been through a period of higher inflation now that it is cooling. So the idea of risk management is we got to realize, we got to acknowledge the fact that in the future, some factors are going to be uncertain.
Yep. And a really great all-encompassing quote about retirement planning. It is the largest financial project of your life, and you can't borrow to finance your retirement. Other
Right.
big financial projects people think about are buying a house, buying a car, doing that kitchen renovation. All of these things while you're working, you can take out that mortgage for. You can take out a loan for. You can finance things. Your retirement can't be financed. It needs to be things like the investments that you have, the savings that you have, the social security and pensions you have.
Right.
There are no financing options for your retirement.
Yeah, you can't borrow. It's self-financed, and thus, and we will talk about this, you must start early and you must be disciplined to continue investing and saving throughout your working life.
Yep. And so when developing that plan for your retirement, you have to think about the needs that you have in retirement. So this is a screenshot of one of the programs that our firm uses called Money Guide Pro. And if you're a current client of ours, you'll be very familiar with Money Guide Pro. And what this software does is it helps you sort of set those goals and set those needs that you have for retirement. And the first thing that you need to answer for yourself is, when do you want to retire? That is going to be a big driver of how much you need to save for retirement, depending on if you want to retire early, you want to retire later. That has a big impact on the plan. And then the second part of that question is, how long are you going to live? And obviously, no one can say, hey, I'm going to die at age 92 in 6 months. That's obviously not realistic. So what we do is the program, Money Guide Pro, uses actuarial data based on your health and family history to come up with a conservative date that you're going to pass away. So for in this example, we have two made up people, John and Jane. We have them living to 93 and 96. Is that realistic? It could be. Are they going to live longer? Are they going to die early? They could. But we like to use average numbers, and then we can plan for living longer or dying early as we go through that program.
But the thing I want to observe, Alec, about this slide is look how long retirement is. The time horizon we're talking about here is 32 years. So if you enter the workforce in your 20s and you work into your 60s, you have a working life of what? About 40, 45 years. So you're saving all of that time, and then your retirement assets have to last more than 30 years. That's challenging right on the face of it. So it's important. Again, it gets at the issue that we need to pound home, and that is start early and be consistent in your saving for retirement because it can last a long time.
Yeah. And one of the other big drivers of assessing your retirement needs is the spending. That's going to influence how much you need to save depending on how much you want to spend. And everyone thinks about, okay, I spend X amount on groceries, X amount on my mortgage, X amount on this, on that. And their monthly expenses are typically the easiest things to think about. The other things you have to think about are your healthcare expenses. As you age, typically you have higher needs for healthcare. Other things like cars. How often do you plan to buy a car? When you're working, you don't have to think about it as much because you have that steady income, that paycheck coming in. You just say, okay, the car is getting old. I need a new one. When you go into retirement, you should really plan out how often you expect to get a new car so that you can plan for it leading up to when you actually need the car. Travel, another big goal a lot of people have. College for grandchildren, celebrations, weddings, all of these different things, you should really think out and plan out so you can determine, okay, I want to spend, let's just say, $100,000 a year in retirement. Okay, that goal might be achievable. We just need to adjust the savings amount throughout your working career to get you to that $100,000 in spending.
So part of the worry-free nature of retirement and investing is being able to identify how much you're going to spend. And that in itself may be for some families quite difficult, but a very important step that needs to be achieved.
And I always like to tell people that with your retirement, it's really just about choices. There aren't any things you can or cannot do. It's just about choices. So someone might come to us and say, I'm retiring early. I want to retire at 55. We'll say, okay, here's what you need to do to get there. You might need to save more. You might need to spend less. These are the actions you need to take to retire early. And it's the same thing on the other side. Someone might say, I want to spend $250,000 a year. We say, okay, in order to do that, you need to work until this age, you need to have this amount in your portfolio and save this month, etc. And it's just about choices. And you need to think about those choices before getting too close to retirement before it's too late. So let's talk about, Roger, what you've been hitting home a lot already is the importance of early investing and just the power of compounding interest. It's one of the most powerful things you can do when you're investing. We're going to go through an example and put some numbers to this in a little bit. And we're going to show you just how important your money making money is. So it's not just about saving the money, it's about that money then earning something on it, and the earnings getting earnings, and the earnings getting earnings, and so on and so forth.
Well, I had somebody ask me the other day for a very practical example of compounding. And of course, compounding for us in finance means your money is earning money and more money. The practical example I came up with was chickens. If you have a hen who lays eggs, and those eggs hatch to be additional chickens, and they lay eggs, that's the power of compounding. Eventually, you had one hen, and you can now have 50 hens laying eggs. That's compounding. Your money that you earned last year is earning money for you this year, and on and on and on. And it is, using the words you have here, very powerful.
Yeah. The other thing with early investing is your time in the markets is typically going to be trying to time the markets. And what I mean by that is putting your money in and investing it and letting it grow is going to be better than if you put your money in and then said, I think the market's going to go down. I'm going to sell everything. And then the market goes down and you try and time buying it back in. The problem with that strategy is you have to be right twice every single time. You need to know when the top of the market is to try and sell everything, and you need to know when the bottom of the market is to buy everything back. And from our experience, that is a very, very, very difficult thing to do and is not achieved usually at all.
At all.
No one has a crystal ball to say, okay, June 17th is the top and October 27th is the bottom. And what we see a lot is people will try and sell because they have issues with things going on in the market. And they say, okay, I think the market's going down. I need to get out. And then the market does go down. And they are thinking, oh, great, I did a great job. I got out of the market, it's going down. But when they don't realize is then the market starts going up and up and up and up, and they don't buy back in at the right time. And they have lost all of that appreciation of the market coming back up because they didn't buy back in.
Right. I mean, lots of folks say they can time the market. I don't know anybody who does. I frankly, as you said, I don't think it's worth a try. You need to be in the markets, stay in the markets, if you will, try to ignore the markets on a day-to-day basis. Stay invested, be a long-term investor. You'll be successful in doing that.
Yeah, and just the last thing about the importance of early investing is early investing allows you to sort of shift your mindset into living below your means. So you have a paycheck coming in, a salary coming in, but by immediately putting money away and saving it, you are shifting your mindset into good habits of when you think about money is okay, I'm saving this money. This is for later. Let that sit, let that grow. I'm going to do it early. And now that my mindset is, okay, I started early, I'm saving it. Now, every time I get a pay raise, let me just increase my savings, increase my savings. And by the time you're at retirement, you're sitting golden because you started early, you lived below your means, and you made sure to save enough.
Many Americans live above their means. And how do we know that? Because we look at the credit card debt levels in families. So family earning $50,000 a year is living like they make 60,000, and the delta is a heavy load of credit card debt. If you make 50,000 or 500,000, it doesn't matter. You have to live on less than you make, and that allows exactly for the habit of saving and investing on a paycheck by paycheck basis all of your life.
Yeah. So let's go into this example, and we're going to show you just the power of that compounding. So person A, they are saving $10,000 per year, and they're going to start at age 25. And let's just assume a 6% return each year on that money, and they're going to retire at age 65. Person B is going to invest the same $10,000 per year, but person B decides, I want to live it up in my 20s when I'm young, and I'm going to spend that $10,000 each year on vacation. And I'm not going to start saving until I'm 35. But they're still going to earn that same 6%, and they're also going to retire at age 65. So when we look at these two, one starting at 25, one starting at 35, they're both saving $10,000 per year. So the person A is going to have an initial advantage of money going in of about $100,000. So they've saved $100,000 more than person B by the time they reach age 65. So you might say, okay, they start 10 years earlier, there's a $100,000 advantage. They might come out a little bit ahead of person B. But what's going to happen is person A is going to end with a little over $1.5 million. Person B, the one that waited 10 years to start saving, is only going to end with less than 800,000. So even though person A only saved $100,000 more, they have almost double the amount of savings by age 65 than person B. And that's because they started earlier and let that 10,000 each year start compounding earlier. And that money just kept on growing. And then person B just could not catch up.
Well, and the other thing I would point out, Alec, is you used a very modest growth rate, 6%, modest and achievable, by the way. So the numbers on the screen are not using enormous growth rates. These are reasonably available growth rates in the market through thick and thin, and yet person A has almost twice as much money as person B.
And that just shows you just how important early investing is. So when we talk about investing, there are different types of things you can invest in. We have stocks, we have bonds, we have mutual funds, ETFs, real estate, alternative investments. And to someone like Roger and myself, we say, yeah, there's all these different vehicles, pretty simple. But for a lot of people that come and talk to us, they say, I don't know what all of this is. what should I be investing in? Like, what is the difference between a mutual fund and an ETF? And what the heck is an alternative investment? And do I need to be in something like that? And it's important to keep in mind that all of these investment vehicles serve a different purpose. So, for example, an ETF could be an index of stocks. So, if you buy a stock, you can go on the market and buy Facebook. That is just one stock. That's all you own if you just buy Facebook. If you buy an S&P 500 ETF, well, that ETF is going to hold a bunch of different companies all in one fund. So you're going to own Facebook, but you're also going to own Amazon and Nvidia and Microsoft and hundreds of other different companies all in that one ETF. And the purpose of owning just that ETF over buying stocks is diversification. And diversification is one of the most important things you can do when investing. So not all of your eggs are in just one basket. You're not just buying Facebook, and if Facebook does well, you're doing well. If Facebook does poor, you're not doing well. And that is the purpose of all of these different types of investment vehicles. And it's going to depend on what your goals are for retirement, what different types of investment vehicles you need.
Definitely. And it is a blizzard, literally, of different types of investments. I think the markets today are more complicated than they were previously. And I would say to everybody listening, really you should be in mutual funds or ETFs that allow you to diversify really across the markets. That's very important. Generally, most investors should be in balanced vehicles, that is, vehicles that contain both stocks and bonds to some degree or another. And we might talk a little bit more about that. But of the vehicles on the screen, it's almost like I want to say to somebody, don't try this at home, because it is a very complicated soup or blizzard, as I said, of different types of investments that act differently through market cycles.
Yeah, and it's going to depend on what your goals are and also what your risk tolerance and risk capacity is for these different type of investments. But we'll talk about that in a little bit as well. So when you think about retiring and think about I need to save money, one of the best options is if you're with an employer that offers a retirement account, you can save in one of those retirement accounts. So these are things like 401ks, 403bs, 457 plans. There's a variety of different employer offered plans that are available depending on the type of company you work for. The advantage of some of these plans is there's an opportunity for a company match. So if you're just saving in something like an IRA, which is an individual retirement account, you don't have any option for any employer match. The benefit of working for a company that offers an employer match is, let's say you put in 5% of your pay and your employer matches that 5% of your pay. That is essentially free money going towards your retirement because of that employer match. Some other advantages of these employer accounts is they'll have typically higher contribution limits than an individual retirement account. The biggest downside to an employer plan is typically the investment options are not great. They're typically will have a bunch of index funds, maybe some target date funds, but it's going to be limited. You do not have a broad view, broad opening of everything in the market. It's going to depend on your 401k service provider or 403b service provider to what investment options are available to you.
So I'd like to describe the employer account as kind of a super IRA. And the reason for that is exactly as you've said, Alec, that is, there is the opportunity for a company match, and the contribution limits are significantly higher. So you can put, if you're able to, if your situation allows you to. You can put a ton of money in a 401k or a 403b or 457. But the limitation is that the investment options are fewer, might only be, as you say, 20 investment options. Whereas we take a look at the IRA, on the other hand, you're able to access many more, really almost an unlimited number of investment options. So let's take a look at that. So in the traditional and Roth IRAs, and of course, the traditional contributions are coming in before tax. The Roth contributions, you pay tax on them and you contribute them, they grow tax-free, and you take the money out tax-free forever, no required minimum distributions, but the contribution limits are significantly lower.
Yeah, that's one of the, it's not really a disadvantage because it's still tax advantage money you're allowed to save for retirement. But when you compare it to an employer plan, the contribution limits are much lower. And the other disadvantage for traditional IRAs, Roth IRAs, there are income limits if you can make contributions. Depending on if you want to do Roth or traditional, there are different limits for each, depending on if you are offered an employer plan. But just know generally there are limitations to either the amount or the type of account, traditional or Roth, that you can contribute to. But as Roger said, the individual retirement accounts have a much more expansive investment list that you can go research and find. It's not like the employer plan where it's just, okay, here are the 20 options you have. It is now the entire universe of stocks, bonds, ETFs, mutual funds, any fund that you can buy, you can go look for and invest in your IRA. And then, as we mentioned already, the individual retirement account, it allows additional savings outside of your employer plan. So a lot of people think, oh, I'm already maxing out my 401k. That's all the retirement accounts I can save into. Well, the IRA limits don't count. So if you have max out your 401k, you can also max out an IRA depending on what your income is.
Indeed. And of course, when you retire, you can, on a tax-free basis, roll money from your 401k, 403b into your IRA and enjoy the expansive, the almost unlimited investment options in the IRA during retirement.
And part of those investment options that you have to think about are, what am I investing in and how risky do I want to be? And there are two types of risk that you have to think about, and they're called risk tolerance and risk capacity. Your risk tolerance is the amount of risk you're willing to take based on your own personal feelings about the market. If you don't like volatility, you don't like big swings in the market, you don't want to be too aggressive. But if you say, on the other hand, okay, I'm okay with a little bit of volatility, not too much, but I don't want to be ultra conservative, you can invest more moderately. That is what your risk tolerance is. Your risk capacity, on the other hand, is the amount of risk you need to take in order to achieve your goals. So if you say, okay, I want to spend this amount and I want to retire at this date, we can go and run the numbers and say, okay, here is the amount of return that you need. And because of that return, we need to take X amount of risk in the portfolio to achieve that return. So if we run the numbers and say we need a 2% rate of return, well, we don't need to take that much risk to get 2% annualized. But if we run the numbers and say, okay, we need 8% to achieve your goals, now we're saying, okay, we need to build a portfolio that has more risk built into it so that we can get that 8% return. And even that is not guaranteed.
So your personality versus your required return, and indeed, You need to make sure that you formulate, as you say here, an asset allocation strategy which helps you diversify. So no matter how much risk you can take or need to take or are willing to take, you must pursue a portfolio, put a portfolio together that is very well diversified. So you have a higher probability of achieving your goals.
Yep. So let's talk about some strategies investment wise for your retirement. And you'll notice a lot of these are things we've talked about, but we want to just really hit home the point of that time horizon plays a role in investing. What I mean by time horizon, it's one, the amount of time you have until you retire, as well as the amount of time after you retire to the day that you die. That is your time horizon. And in within that, you have other time horizons like, okay, I need to spend, X amount of dollars each month. We can plan for that. Your other time horizon is, okay, in 5 years, I want to do this. I want to buy a car. I want to pay for a wedding. Those goals are going to have different needs in your portfolio. So your longer time horizons, things that aren't going to be paid for years and years and years, can be invested differently because we don't have to worry too much about the volatility in that portfolio because we're not drawing upon it. But for more immediate needs like monthly spending or a car in 2, 3 years, we need to be more conservative because we don't want to see swings in the market. And then you call us and say, hey, I need that money. And we say, ooh, we want to make sure that we're invested properly so that when you do make that call, we say, okay, we plan for this. We have it invested conservatively. We have the money available. And that's just that long-term versus short-term
Short-term.
idea of how you invest the money.
So and I think the classic question is, should a 25-year-old have the same portfolio as a 60-year-old? And the answer, of course, is no. The 25-year-old has a much longer time horizon to retirement as opposed to the 60-year-old. And so importantly, I think you highlight the fact that some of your money needs to be available very short term due to unexpected emergencies and the need to pay your expenses for a living.
Yeah, and part of those investments within that time horizon, you have to consider passive management versus active management. And the difference between the two is passive management is sort of setting it and forgetting it within an index. So you might buy things like an S&P 500 index, an international index, a small cap index, a mid cap index. And what these funds are is they just own the index. They're not trying to do anything fancy. They're not buying and selling each week. They're just a basket of companies that are bought and held. Active management, on the other hand, is typically run by a fund portfolio manager that's making active decisions. So they have a team of analysts and they're studying different companies and saying, okay, we want to buy this one if it's at this price, or we need to sell this company if it does this, or they're doing all this different research within the different specific companies to buy and sell them at different intervals. So there are pros and cons to each. And for a lot of people, they like a little bit of both because there are some years where active managers will outperform. And there's some years where passive managers or passive ETFs and funds outperform active management. And what we're truly finding is there are different asset classes where active managers outperform the indexes. There are some indexes that are hard to beat on a consistent basis. But there are some sectors of the market that an active manager can take advantage of and outperform the index.
Yeah, very well said, Alec. Very well said. I agree. And so the conclusion we have come to is we're using both passive and active management in ETFs and funds in our portfolios for the reasons that you've stated, passive, uncomplicated and inexpensive, active, more expensive and more complicated. And we believe strongly active management can add value, but it doesn't add value every year.
Yeah. So another strategy for investing is you can do different tax planning with the investments you have for different accounts. So, for example, a Roth IRA is an account that is growing tax-free. So when you think about an account that's growing tax-free, one consideration can be let that account grow for as long as possible, so you're not drawing upon that account, so that that money, when you do draw upon it, has seen the most growth and now it's tax-free. So if we think about that strategy, what we'll want to do is invest that account more aggressively because that time horizon is longer. We're not going to use that account for a long, long time because we want it to grow. So by doing that, we can invest that more aggressively. On the other hand, if we have a brokerage account that is producing dividends, interest, we have capital gains when we sell things, we might want to invest that in some funds that aren't kicking out a lot of dividends, are not kicking out capital gains distributions. Invest in things like ETFs over open-ended mutual funds to sort of take advantage of that tax advantage.
Yeah, definitely, Alec. We don't want to ignore the fact that taxes are a large expense that come into play no matter how you invest. We don't let the tax tail wag our investment dog, but at the same time, we got to acknowledge that taxes are an expense and we got to take them into consideration.
So some of the mistakes to avoid when investing for retirement is, as we mentioned earlier, trying to time the market. Nobody has that crystal ball. You can't ask your magic 8 ball what the market's going to do. Don't try and time the markets unless you're able to deal with the consequences of being wrong. Time in the markets, investing and holding will usually outperform timing the markets. Another big mistake is neglecting fees and expenses. There are funds out there that charge higher fees than other funds. And in some circumstances, it's worth it to pay that higher fee because the fund performance is worth the higher fee. But it's important to look at that and just make sure that you're not paying a higher fee just to pay a higher fee. It's always good to take a look at all of the different funds you own and make sure those fees and expenses are in line with how the fund is performing compared to its peers. Another big mistake is a lot of people ignore tax implications. I don't know how many times, Roger, you and I have seen clients come in and they've done things in the past that we just have to shake our head at. They took money out of a traditional IRA and paid taxes on it rather than taking money out of a brokerage account that would have came out after tax. You have to think about these things, and it's okay if you don't know these things. If you work with us, always just ask us, hey, I need some money. Where should I take it from? It's always important just to educate yourself and make sure you're not causing any adverse tax consequences. A big mistake a lot of people do is they try to beat the market and they aim for a killing. When you're trying to swing for home runs all the time, you're going to strike out a lot.
Strike out a lot. That's right.
If you're trying to hit singles and doubles, yeah, you'll hit some strikeouts, but more often than not, you're hitting those singles and doubles rather than trying to hit those home runs. And it just works out better when you're not trying to shoot for the moon because a lot of times you're going to miss.
Well, the example of compounding you used was a 6% return. That's a very modest return. So I think it really shows that you don't need to beat the market. You don't need to aim for a killing. You don't need to try to time the markets. You need to be a diversified, methodical investor, staying in the markets all of the time. Those are really the seeds of success, and you can avoid those mistakes really pretty simply.
Yeah, and then some strategies to avoid any pitfalls is set it and forget it. Now, we can't just say, okay, pick some investments and then don't look at it for 40 years. But what we're saying is don't try and tinker with it. If you put money in investing, invest it. Don't try and time the markets. Don't try and buy and sell at different times. Those strategies usually don't work out. By setting it and checking it every so often, do a quarterly review of your portfolio, semi-annual review, annual, that works out better than trying to look at your portfolio each and every day to make changes. Being a long-term investor, that sort of goes in line with setting it and forgetting it. Being a long-term investor means you have set your horizon for the future. You are not trying to time the markets. You're not trying to beat the markets. You are in it for the long term. You are accepting the volatility within the portfolio because you know by the time that you need the money or by the time you retire, the portfolio is set up for you to achieve your goals.
Yeah, I try to tell clients, hey, look, don't look at the markets. Don't watch the news. It sounds like when you listen to the financial news, that the people who are being interviewed or in the Wall Street Journal, they know where the market is going. They know what to do, and they do not. That's really entertainment value, not investment value. So if you pay attention to the news, they're going to try to motivate you to move your money around, to get in and out of the market, to make these bad decisions. And we would suggest you try to ignore all of that.
Yeah. And don't watch your account balance. That's one of the things a lot of people get stuck in, and it causes a lot of anxiety when they look at their account balance and they watch it go down, then watch it go up, and then watch it go down. Because on a daily movement, you will see one day you might be down 1%. The next day you might be up 1%. There are movements in the market, and by watching your account balance, it just creates unnecessary anxiety because markets move. They go up and they go down. If they didn't go down, they wouldn't be able to go back up. So by checking your account balance too often, it just causes unnecessary unease. And then lastly, and one of the most important things is don't assume someone knows what the market is going to do. If someone tells you this is a great time to buy, you're going to get 5% return. Don't listen to them, run away. Nobody knows what the market is going to do. We can make predictions, we can expect returns, but just because we can make predictions doesn't mean they're always going to come right.
Well, long term, we expect the markets to go up, and they do. But Warren Buffett may be the most successful investor of modern times. Says he doesn't know what the market is doing on a day-to-day basis. He doesn't know what's going to happen short term. But again, long term, if you look back in history, it's very clear. The markets go up. They go up and they go down, but mostly up. So there's no reason to watch your balance. There's no reason to worry about where the markets are. Is this a good time? Should we get in and out of the markets? All of those are pitfalls, which you can easily avoid by essentially, as you said, setting it and forgetting it.
Yeah. And then the last strategy to use is to use some retirement planning software. The program we use is called Money Guide Pro. And what we do is we put all the inputs in. So retirement spending, retirement dates, retirement income, social security, pensions, investment assets. And then we run a bunch of different scenarios to stress test the portfolio and see how successful a person's plan is. And Roger and I actually did a full webinar walking through this software, Money Guide Pro, and you can find that on our YouTube page. It's called How to Not Run Out of Money During Retirement. And we walk through a full example plan of what to be thinking about and how to sort of think out your retirement plan and stress test it in different ways.
Well, if you look at the chart, if you look at the graph, it embodies the notion that the future is uncertain. I mean, look at the difference in values at the end of this 30-year period. In some cases, this particular client did run out of money. And in some cases, they were worth millions. And the middle value is certainly somewhere in between. But what we do know is the path in the future is uncertain. There are many uncertainties. And how do you get past that? You get past that by not getting in and out of the market, not trying to beat the market, not trying to make a killing, but staying invested and then monitoring your investments with your advisor.
Yep. So if anybody has any questions and you're already a client, you can reach out to either Roger and I if you have specific questions, or you can reach out to your primary advisor with any questions. If you're interested in becoming a client, you can either scan the QR code on the screen to schedule an intro call, or you can go to financialconsulate.com and learn more about us. If you are interested in becoming a client, we just want to let you know who the typical client we work with is, and we like to call them the practical millionaire. And the practical millionaire is someone that typically lives beneath their means and they value their financial independence over their social status. So if you're interested in becoming a client, we would be a good fit if you're seeking a long-term partnership with an advisor, you're seeking a comprehensive advisor that doesn't just work on investments. They do all different areas of financial planning, including investment management, but as well as estate planning, insurance planning, tax planning, and all the other different financial planning areas. And lastly, we'd be a good fit if you're seeking an advisor with an expertise in tax planning that also offers tax preparation in addition to that tax planning. So again, if anyone has any questions, please reach out to us. We'd be happy to have a further discussion. And on behalf of the entire Financial Consulate, as well as Roger and myself, I hope everyone has a great afternoon.
Thank you for attending.